go. What's up, everybody? Welcome to another edition of What the FICC. Spencer Israel here with Ian Culley, the FICC master, aka I don't know. I don't have a good nickname for you. Sorry. Head of FICC at All Star Charge. What's up, Ian? How we doing?
All right. How you doing, Spencer?
Doing fantastic. You know what? It's the Friday before a long weekend, so I'm in like an amazing mood right now. You know what I mean?
Absolutely, me too. And it's a really important close because
Why is that?
we get information in terms of the risk that investors are willing to take over the long weekend.
True. And also Tuesday's close is very important because that's the end of the month.
Right. A lot of rebalancing there at the end of the month.
Yeah. All right. Let's start with our FICC market recap here. We'll start with gold. Are gold bugs in a good mood today? I'm guessing not.
You know, gold's trying to dig in a little bit. Not having much success here this morning. The June contract trading around 1943, and key support levels, near-term support levels. That February pivot high turned into support earlier this month, late last month, has been lost. Prices undercut this critical near-term polarity zone, and now the path of least resistance is lower for gold. Now, we saw that happen in silver a couple weeks ago. The gold miners, we'll get to those in a minute, also breaking down. It's selling pressure is hitting the precious metal space, and the bears are taking control. Going to the wayside, attention turns to those prior cycle peak, last commodity super cycle, the 2011 highs around 1924. That is the next potential support level for gold futures, and it's a level etched in the minds of gold bugs everywhere. Now, what's interesting, look back at 2011, kind of a blow off peak here, kind of a blow off top. Yeah. So not a lot of investors or traders transacted at this 1924 level back in 2011. Fast forward to the past couple of years, and lots of attention, a lot of contact points around that level. Because it's that price memory. Everyone remembers when gold peaked back in 2011. Right. Now, if gold slips back below that level, it's not good news for the precious metal space in general. Gold continues to slide below that level, and you can imagine that pessimism is going to creep in. And if higher prices aren't, if gold isn't catching higher, then there's not a lot to be excited about. So I'm keeping my eyes on that 2011 highs around 1924. We're about $20 above that level right now in the June contract. So that is the focus.
In your eyes, this is like the mother of all levels in gold.
Yes, it is. It is for the bull case near to intermediate term. If gold drops back below that 2011 those 2011 highs, then we're most.
But if it holds, on the other hand,
but we hold, gotta give precious metals, gotta give gold the benefit of the doubt. Now, when we look at the GLD, the gold shares ETF, now it's already undercut those former 2011 highs, and it's already catching lower. We zooming in, it's around that 180, 150 level. Again, those are similar to this chart here, the February pivot high, April lows, undercutting that level as well. So messy. Looks like GLD's headed towards the middle of this multi-year range. This isn't something I want to hold on to right now.
So, it's messy. Hold on there. So if the GLD ETF has already cut below the 2011 level by a long shot, right? Or not by a long shot, maybe but regardless, it's cut below it. Does that serve as like a leading indicator to you that the actual gold futures would do the same as well?
No, not necessarily.
Okay.
I usually do the flip side of that. I look to the underlying commodities of any particular commodity ETF as the leading indicator.
Okay.
Versus the actual.
So wait, why do you suspect the GLD fell below this level while the actual price of gold has not?
Just more sellers and buyers in GLD. Yeah,
Good
I
answer.
just, that's just the price levels for this particular market. It kind of gives us an idea of what that would look like if gold started to catch lower.
Yeah.
And then going on to the gold miners, it looked like they were, buyers are going to step in and repair the damage, and that just hasn't been the case. Miners continue to catch lower. This is not a positive development for the precious metal space. This is kind of along the same lines as silver. These are, riskier assets, higher beta, and we had a question about GDXJ earlier in the week. I brought a zoomed out chart. We got that violation of the downtrend line, and it's constructive, but still in a massive basing formation, potential basing formation. Now, it looks constructive, but price is still stuck below overhead supply around $50 for the junior miners. As long as that's the case, I mean, it's messy. It's messy. So this really speaks to the miners and just precious metals in general still have a lot of work to do. And when GDXJ is breaking down on an absolute basis, and it's starting to resolve lower on a relative basis versus the broader market. This is the gold miners ETF GDXJ versus the S&P 500 SPY. And we had that violation of the downtrend line here. Now it's slipping back below that downtrend line. So not looking good for the miners right now. And with silver, this is the high beta, crazy cousin. This really kind of gave us the heads up, really kicked off this pullback in precious metals. Is just accelerating to the downside right now.
All right. Let's move away from the metals into energy.
Crude. Strong selling yesterday in crude. Looked like it was going to reclaim this 74 level. And then this 74 level coincides with the prior cycle high in 2018. Between 74, 76, kind of in that zone. Lots of resistance right here, even though it might not be visible in this zoomed in look here. 74 is a big level. Still trading below 74 today, though. The buyers did come in and drive prices a bit higher, almost $1 up now on the day, around 72.60 in the July contract, but still messy. Still in the lower area, lower range of this, 6-month range for crude oil. Looking at USO, levels about 58.50. It's about 58. As long as USO is holding above 58, gotta give USO, gotta give oil the benefit of the doubt. But it's looking more like a pattern that I would want to sell. Of course, I wouldn't sell it unless we get that completion, that breakdown. It's looking more like a topping pattern to me at this point. However, looking at our equal weight energy index X ethanol, this is just we're equal weighting crude oil, heating oil, gasoline, natural gas. Now it undercut the prior cycle high from 2018. It's looking like it's trying to repair the damage here. Now, it can reclaim this level. And energy is, the broader energy space is most likely catching higher. XLE is holding above that 75 level, catching higher. Crude oils breaking above 74. So this is key level here for this index. And we're starting to see a little bit of relative strength, a little bit of rotation out of the base and industrial metals into energy. Now, this is the our energy equal weight energy index versus our equal weight base and industrial metal index. So relative to base and industrial metals, energy is starting to catch a bid. And you can see this right off of a level that it acted as support for almost a decade. Of course, aside from that 2020 sell-off and the base that it formed in the year preceding. So key level logical level to see a reversal in the relative trend between crude oil and base industrial metals, and we're starting to see that. So it's constructive for the energy space. But you got to imagine some of that's being driven just by the weakness in base industrial metals, just by the weakness in copper. Copper recently hitting fresh lows, undercutting a key polarity zone marked by the August pivot high and the lows from earlier in January. This is not the kind of action you want to see in an environment where stocks are catching higher, stocks are kicking off a new bull market. So I got an eye on copper. I got an eye on Freeport-McMoRan. This is the copper mining bellwether. These two charts tend to move tick for tick, and seeing FCX potentially break down is not a good sign. Bull stepped in yesterday. If they can drive these prices back above 33, that would be extremely constructive for the overall market. And of course, I think it all comes down to the dollar and rates.
Yeah, I was going to ask you about this because the dollar, or at least the 10-year, has gone sideways for how many months now? 5, 6, 7 months in a row now. Just sideways nothingness. But the dollar at least has started to bounce these last few weeks.
The dollar has started to bounce. It's still within a multi-month range, and rates are bouncing with the dollar. And you see in the lower pane here that 126-day rolling correlation, and it's just been positive since the fall of 2021. We really started to enter that rising rate environment driven by inflation. Last spring, the Fed started to hike interest rates, and that also fueled this strong positive correlation. And I think this correlation stays in place, until I always defer to price. I gotta let the markets tell me and price action prove to me that this relationship is no longer intact, and that's just not the case right now. And as long as the dollar rates can continue to rise, some of these cyclical assets are going to have a tough go, which is really interesting. Imagine if rates are rising, copper and crude oil should be rising along with it. And that's a key point I want to get to, or a key development I want to get to later today. Moving on to yields. What's interesting, talking to JC earlier this morning, and he, pulled up a chart of the 10-year yield, and he was looking, it's like, it just looks like a healthy consolidation within an ongoing uptrend. And, to step back, cover up the title here, or cover up the upper left hand corner of the chart, and, imagine it was a stock or sugar or cocoa or, soybeans. It just looks like a healthy uptrend. And to see the sideways consolidation in the 10-year and the sideways consolidation at 30-year at these logical levels, 30-year right below the psychological 4%, marked the top in 2014, the 10-year turning just below similar level that marked the highs in the late 2000s and in 2010. So this just seems logical level to see a pause in rates. And that's what we've seen. Nice, tight consolidation. So no real evidence suggesting, at least from rates themselves, of a breakdown.
That's a very good point, though, that you bring up. How often do you find your analysis is ever colored by the title of the chart, and as opposed to the chart itself? Like,
oh, sure, absolutely. Like, it's impossible. I'm human.
Notions. Yeah,
I'm human. Absolutely.
Yeah.
I look at a chart and I know, I know what it is, and that's and all of my biases start to kick in. Those that I'm aware of, and all the ones I'm not aware of. Yeah, that's I can't help that. And what's interesting is, I'll get to some charts later. Let's go ahead and dive into those charts right now, since we're talking about rates. You might as well. The intermarket evidence has been suggesting for months that rates are going to roll over. Now look at the copper gold ratio breaking down to fresh 2-year lows. That's not the type of action. That's not the type of movement in the relationship between copper and gold that we would tend to see during a rising rate environments, or just when rates are starting to catch higher. So it doesn't fit, right? Copper gold doesn't fit. What about regional banks versus REITs? And you can, talk about the stress in the regional banks, and throw this ratio out the door. But
I was going to say it's worse and worser. So
yeah, but just because there was a crisis across the regional banks, I don't think that negates the insight that this ratio is providing. And it's been telling us for months that rates should roll over, or not even that they should roll over, but the rise in rates is not sustainable. Same thing when we look at small cap value versus small cap growth, or just value versus growth. Breaking down. That's not what we tend to see when rates are on the rise. How about, just small caps versus large caps? As you can see here, going back a decade, these look almost identical until spring of 2021. What happened in the spring of 2021? More stocks started catching lower, printing fresh lows than new highs. And that was really the beginning of the deterioration of the uptrend of U.S. equities.
Wasn't that the top?
Yeah, I mean, it wasn't the top in price, but it was the top in terms of supporting breadth.
Yeah,
if that makes sense. And then this is the kicker. But the equities themselves, on an absolute basis, that should be rising in a rising rate environment. Look at this ETF. I mean, ProShares makes it really easy for us. Equities for a rising rate, that's
okay.
It doesn't get any better than that. EQRR should be catching higher as rates rise.
Okay, I have just a word of caution, and I love ETFs. I think ETFs are probably the greatest thing to ever happen to financial services. They're awesome. However, look under the hood, right? Sometimes an ETF will have a certain name, and you look at what it actually holds, and it might not always jive with the name. I'm not saying EQR doesn't, but the name might imply it's supposed to do a certain thing, right? Like all these like last year, all these TIPS ETFs, right? The TIPS ETFs did not perform well, right? Because if you know anything about them, they're supposed to perform well during periods of unexpected inflation, right? Unexpected being the key word there. Last year we had expected inflation, at least in the back half of the year, right? So, or most of the year. So, but the point is, ETFs are great, but don't get mesmerized by the name, right? Look under the hood, always.
Absolutely, and that is a great point. And when we look under the hood for EQRR, 30% financials, almost 20% industrials, materials. So it's predominantly these cyclical groups. So it's I think it's a good ETF, and I'm surprised that it looks like it's carving out a top. It looks like it's a much larger consolidation, but it looks similar to what we see here in the copper gold ratio, except copper gold has broken down. It looks like it's consolidated and then fresh leg lower.
Yeah.
And what's interesting is it stopped going up around the spring of 2021. So just something to think about. That's kind of what really has my attention. But to get back to interest rates, they continue to rise. So it doesn't matter if all this overwhelming evidence suggesting that rates are going to roll over if they don't. But it gets back to some of these commodities. It gets back to oil, digging in and catching higher and staying above the 65 level, USO holding above 58, and the buyers coming in and supporting and driving prices higher in Freeport-McMoRan. Those are the things that I expect to see, in the coming weeks and months, especially if we're going to get that healthy rotation out of tech. Another piece of evidence suggesting that rates roll over. If tech continues to catch higher, long duration asset. You imagine that's happening in an environment when rates in a lower rate environment. So interesting, very interesting.
Ian, do we have any favorite charts this week?
I do have some favorite charts this week. The dollar catching back up towards that 105 level. And I think it's really interesting that, we never got those, the lower, like a lower low here in the G10 currency index or our AD line. Actually, if you look at the G10 currency index, it's actually breaking above the pivot high. It's making a higher high, and then it made a higher low as the US dollar index made a lower low. So, if this continues to catch higher, then I imagine the dollar index is going to follow. And, one of the charts that I was looking to for confirmation that we were going to see a sustained downturn in the US dollar is the Aussie, Canadian, and New Zealand dollars. These are risk-on commodity-centric currencies. And if the dollar was going to continue to roll over, these were going to catch higher. They were going to reclaim the July pivot lows from last year. Canadian dollar never got there. The Aussie tried, but back below those pivot lows from last summer. And it looks like the New Zealand dollar is about to undercut those lows here any day. So not looking good for dollar bears. Again, that 105 level is still, that's a logical level of potential resistance. We'll see if it holds. Again, if the dollar's back above that level, then rates are probably rising and risk assets are probably under pressure.
All right. What else we got?
Got live cattle. Live cattle. I just love this chart. I brought the zoomed out chart. I know I talked about cattle in the past couple of weeks. I love it's like the base on base on base on base. This off of those 2020 lows. This is what a strong uptrend looks like. This is what a strong uptrend looks like. And what's funny, looks a lot like the 30-year yield. Looks a lot like the 10-year yield. So, live cattle futures, August contract, printing new contract highs today, as long as, live cattle is above this 151 level, longer term trend back up. These are new all-time highs up here, like it long towards 185.
Hello.
And then last but not least, I got one more chart for you today.
Yeah.
Cocoa. Just wanted to check back in on cocoa futures.
We've been talking about this one.
Yeah, it broke out, retested the 28 and a quarter, 28.50 level, and has continued to just, slowly grind higher within a channel. And I'm not really big into diagonal trend lines. I far prefer a horizontal boundary to define risks. And I'm not really using these levels to define risk. I just want to highlight that these series of higher highs in cocoa futures have been met with a series of lower highs in the 14-day RSI. We call that a bearish momentum divergence. Just seeing this uptrend is just losing steam. So one or the other, I want to see price, I want to see momentum hit an overbought reading of 70 to support the uptrend in price. And if not, I imagine getting back down towards that 28.50 level, 28 and a quarter. If we lose that level, it's messy. It's messy below 28 and a quarter. All bets are off from the long side for cocoa futures below that level.
All right, Ian, you and I we're going to do a new segment today, but I don't think we have time for that. So let's just put it on the back burner and do it on a Wednesday. We're gonna do a little would you rather. I'm gonna ask Ian, would he rather buy two markets, one market or the other? Yeah,
I like it.
We'll do that on Wednesday.
Okay.
There we go. So okay, that'll be a wrap for the show today. Of course, we'll be back on Wednesday. The show airs live every Wednesday and Friday, normally at 11:30 a.m. Eastern time. So check back here, Stock Market TV, for that. Want to mention also that Ian Culley is part of the team at All Star Charts that is searching far and wide for the one perfect chart to send directly to your inbox every single day. It's the All Star Charts chart of the day email. There should be a link in the description or on the screen. It's free to get that email. Any questions, you can always email us. There's the link right there. I'm on a delay, but there it is. allstarcharts.com/chart-of-day. If you want to learn more about All-Star Charts, about Ian's research, about these markets, the fixed income markets, the oil, gold, silver, copper, you name it. You can either call that number on the screen. You can always email the email that's on the screen as well. And we will tell you more about how you can get access to Ian's research, how you can get access to Ian's charts and all that good stuff. That's it. I guess thanks for watching. Smash that like button. Thanks, Mary. Thanks, Sam, in the chat. Ian, have a great holiday weekend. And I'll see you on Wednesday.
You too. Have fun, guys.